Why do so many investors pay attention to the Federal Reserve? The answer is because nearly every market crash for the last 100 years, the central bank tightened monetary conditions before the market crashed. So you have a long history of central bank tightening, then leading to a financial crash. And that's led to some of the industries tighten, the financial industry titans, like Ray Dalio, Paul Tudor Jones, or Stanley Druckenmiller, all billionaires in their own right with incredible investing track records, to watch the Federal Reserve moves, the central bank moves around the world, to understand what they're doing, because central bank tightening leads to tighter monetary policies that ultimately lead to tighter economic conditions that usually drive the market, usually drives the stock market one way or the other. Typically, as things get tighter, market goes down because you have an opportunity cost. So what did Jerome Powell, the head of the Federal Reserve, indicate today? Interestingly, he indicated a couple of things, a few changes. So first, he indicated that they expects 2 rate hikes in 2023, and this was a change in that they previously indicated back in March, just a few months ago, that they didn't see any increases until 2024. So they're bringing up the timetable of when they're expecting to hike. This suggests that the headline inflation figures were hotter than they expected. Now, in fairness, they were. I mean, they still believe inflation is transitory, but the inflation that they've seen has exceeded their own expectations, leading to them sort of accelerating the rate in which they go from very loose monetary policies to potentially a tighter policy to offset this potential inflation. They also left their insane QE policy, or quantitative easing policy, to sort of encourage the economy and its growth with $120 billion of monthly security purchases. And keep in mind, these securities are being purchased effectively with newly created money. So this is effectively new money coming into the system each month. It's particularly ridiculous when you see the housing supply and home prices just going up radically, and a huge chunk of this Federal Reserve purchases, I think about $40 billion each month, is going for effectively mortgages, and so that only makes the market tighter, in my opinion, or translates to an even tighter money. It just doesn't. You don't need to have such a tight housing market in this example, and you certainly don't need to have billions of dollars of securities bought by the Federal Reserve. So what are investors to do? I mean, is it time to keep on dancing? As Chuck Prince, the head of, Citi, once said before the great financial crisis, he would say, hey, look, the music's still playing, so we got to keep on dancing. And that, of course, led to terrible returns for Citi shareholders as Citi later imploded. Personally, this has little impact on my personal journey as I look to invest. I try to take an unrivaled focus. I'm looking for unrivaled companies that I think are exceptional, that have a right to win longer term. And that's sort of the basis for this whole channel, is trying to find these exceptional, these potentially unrivaled companies, because maybe they have the potential to grow hundreds or even thousands % over time. The trick is finding them early on and trying to get in as you watch them deliver over time, trying to find these exceptional rides. If that is something that you're interested in to follow my own personal journey, go to unrivaledinvesting.com. First week of the month, I call out my full portfolio, and then during the month, I call out at least one idea that I think is a multi-bagger. And the reality is, just finding one potential multi-bagger in your lifetime can change your personal life journey. That said, so being this sort of laser focus on the Federal Reserve, that's not really my approach. I'm taking more of a bottoms-up approach, but it is good to understand what's going on, especially when you see how many investors are paying attention to it, especially these major, very successful hedge fund and institutions that do move the market. So it's good to know a broad sense of what type of environment this is. Is this a time to be hyper aggressive, or should you want to be more mindful of the downside risk? And in my mind, the downside risk is inherently there. You see margin debt continues to explode higher, and valuations are still in a hyper expensive state. Personally, I view the Chuck Prince quote of, is it time to keep on dancing, or when the music's playing, I'm going to keep on dancing. Personally, I prefer that, hey, when the music stops, I can get a chance to buy companies at a cheaper valuation. And when you buy something at a cheaper valuation, you sometimes can have just very attractive risk rewards, the types of returns that can be life altering and potentially create generational wealth. That's ultimately what I think you're more likely to achieve in environments like this, when margin debt is rapidly contracting, versus what you have in a period like this where people are increasingly bidding up securities. Now, speaking of this sort of lofty environment, Dr. Michael Burry even chipped in, going from his brief hiatus, where he said, people are effectively asking what is going on in the markets. It's simple. It's the greatest speculative bubble of all time and all things by 2 orders of magnitude. If there's someone that would know what to do, I think it's Dr. Michael Burry, who does have sort of a pulse on the market. And so, is it time to get rickety wrecked? And I just don't think so. I don't think it's the time to be going crazy in the equity markets. That said, you may be able to, sort of pick your shots in terms of things that could benefit from a very loose Federal Reserve. And I talked about that in my last video in terms of Paul Tudor Jones calling this a crazy market. It's clearly frothy. And so the question is, is the music still playing? If Michael Burry's saying this is by 2 orders of magnitude frothy, it's worth noting that. And is the music still playing? Can you expect, one last hurrah? And as I look at it, I think there are a couple of things to understand. One is to understand interest rates, treasury rates, and you see how the treasury market, and I'm very curious to see how it performs in the coming days. Today, what you saw was a brief uptick in the short-term rates, where you see the yield curve moved imperceptibly flatter throughout this time period, whether or not it's from 1 month to 30 years. And that suggests that rates in the near term, people are concerned that rates could go higher sooner than expected, and that's the reason why the 1 month and the 2 month did have this sort of slight uptick. And you notice it's actually quite flat relative to what it's been. I mean, it's been, 0.01, 0.02, 0.04, and now it's 0.04, 0.04, 4 basis points across the board for 3 months out. And so, but you didn't notice a big uptick in 30-year. So effectively, I think this is saying, hey, you know what? You're going to have potentially higher rates, which might result in higher sort of short-term securities, 1 to 3 years out, in terms of what the rates could look at with higher inflation. But then it's going to result in a tightening. Things might get a little too hot. The Federal Reserve will have to step in, and that's the reason why you're not seeing this sort of big uptick in 20 to 30-year interest rates. Here it is. It only moved 1 basis point for the 20-year, and the 30-year didn't move at all, which is really suggesting, like, hey, this once the tightening occurs, there's no way inflation gets out of control. That's effectively what the Treasury market is pricing in at this point, saying, hey, once the Federal Reserve wants to clamp down on potential inflation, they'll succeed at doing it, and the economy will also take a hit, and therefore these sort of low rates for 20 to 30 years will actually still be appealing in that environment, and will actually hold down longer term rates. So I think that's one perspective, is to monitor what's going on with Treasury rates. It's interesting, Michael Burry does have a bet against the long-term Treasury market, and so I'm very curious to see how that plays out. So far, it's been directionally heading favorably for him, in that it's going against the market. And then the next key component is to watch the near-term inflation. As Jerome Powell had a critical line where he said, and here's a direct quote, "Our expectation is these high inflation readings now will abate." That's critical to think about, in my opinion, if this is your thing in terms of studying the macro and thinking top down. Because if you were to get a sustained high single-digit inflation rate in the months ahead, something that's in excess of their expectations, I think you actually continue to bump up that timetable of when you have that potential rate hike. It just went from 2024 to 2023. Could it happen in 2022, maybe even the 2021, if you see really high rates? And that would be quite a development. It would require this sort of higher inflation readings to continue to occur. So, as I look at this and I think, what's my personal take? And keep in mind, this is not how I personally invest. Journey subscribers, if you go to unrivaledinvesting.com, click on Journey, they know I'm focused on bottoms up. I just called out one company where it's like, hey, I think my downside's covered, and I think there's 200 to 300% upside. And last month I called out a stock trading below liquidation value that I also think has nearly 300% upside over the next 5 years. So that's how I'm thinking. I'm looking for attractive risk reward. That said, it is worthwhile to understand how these global macro funds do think. And this is, in fairness, part of my background working on Wall Street was working with a multi-billion-dollar hedge fund. So it is worthwhile to consider these perspectives, these different institutions, and that's what I'm trying to bring here to you on this channel. And so my guesstimate of what I think happens is that you might get some turbulence in the near term as the Fed did accelerate the course to potentially hiking rates from 2024 to 2023. That said, after an initial shakeout, and I don't know if that's a 5% drop, a couple percent, 20%, they're still massively loose with their policies. 120 billion in securities bought each month with newly created money. I mean, that has to flow through the system somehow, and that does generally juice prices. And once again, going back over the last 100 years of market cycles, you don't really see a market decline without the implicit, without the Federal Reserve explicitly tightening rates, explicitly saying, hey, we are making financial conditions a little tighter. They are not doing this. If anything, you might just see them stop QE, but that is not really tightening it. You might still see a temper tantrum, we'll see, but saying no rate hikes for a year and a half, that could be perceived, as Paul Tudor Jones suggested in his interview earlier this week, I made a video about it, that look, it's effectively a green light and to go all in on the inflation bet. His inflation bet was effectively, hey, own some Bitcoin, own some gold, own some commodities. The NASDAQ could continue to rip higher. Yes, you might have that sort of short-term shakeout just from the uncertainty that the Fed created with this in terms of raising the profile of the time frame of when they might hike. But still, they're saying 2023 is when it happens. So in which case, you might get the Paul Tudor Jones case where he's saying go all in on the inflation trade. In which case, I'm wondering, like, hey, what are the commodity stocks that are unrivaled? And that inherently is really, really tough because these commodity plays, effectively they're price takers. And, so if you have any thoughts on what companies operate in a commodity space that you think are unrivaled, where they stand out from other commodity players, maybe they're a low-cost gold producer, maybe they're a low-cost oil producer, something that's special about them, I'm very curious about it just because, I am interested in finding unrivaled companies. That's my focus. And if it could be maybe a commodity play that could directly benefit from this, maybe an energy play that's unrivaled, I'd be very interested. That said, I have real trouble finding those types of companies. It's so dependent on the cycle. I mean, personally, I would rather stick with the Alibabas of the world, where it's effectively a marketplace that benefits from, higher prices over time. It's a video I called out, a few times where, I think this is a compelling stock. I personally own it. If more goods are being transacted at a higher price, Alibaba would win, as do all marketplaces in that type of environment. So anywho, if this video, talking about what's going on with the Federal Reserve, what is the sort of the guesstimates of what to do in this environment, if this video has been helpful for you, please make a point of subscribing. If you're already a subscriber, I do appreciate that thumbs up. Thanks so much for watching.